Broadcom, AVGO, just delivered the kind of AI quarter that should come with confetti. Revenue up 15% sequentially, AI chips screaming, and yet the stock got absolutely whacked after hours. For posterity, it's June 3rd, 2026. You're listening to Earnings Unscripted, and we're looking at Broadcom's fiscal Q2 2026.
Yeah, and the tape is the funny part. Not funny, haha, funny as in markets took one look at a monster quarter and said, explain the margin future to me like I'm suspicious.
The baseline is huge. Revenue was $22.19 billion, up from $19.31 billion last quarter, and GAAP EPS rose to $1.91 from $1.50.
And operating income rose even faster to $10.79 billion. GAAP operating margin jumped to 48.6% from 44.3%. Revenue was basically a little above the company's own roughly $22 billion setup, but I don't have a clean street EPS estimate in the pack, so I'm not going to invent one.
Good. Yes, we are allergic to invented numbers here. And quick legal seasoning, this is not financial advice, just our personal opinions with spreadsheets nearby.
Very brave spreadsheets. But look, the quarter itself was strong. Semiconductor revenue was $15 billion, up 20% sequentially. Infrastructure software, the VMware side of the house, was $7.18 billion, up 6%. So this is Broadcom doing both things, custom AI chips and networking for hyperscalers, plus sticky enterprise software.
And then the market reaction says, no, thank you.
Pretty much. Important distinction. The stock had a great quarter into this print, up about 29% over the period and finishing near its highs. But the immediate post-earnings reaction was sharply negative. Latest print in the data was 413.83, down about 14% versus the prior trading close.
That is a real mood swing. Like, congratulations on the sprint. Now please step onto the scale.
Exactly. And the scale is mixed. AI semiconductor revenue was $10.8 billion in Q2, up 143% year over year, and management guided that to $16 billion next quarter. That is not normal growth. That is a freight elevator.
Wait, $16 billion next quarter just from AI semis?
Yes, and Hock Tan said AI bookings were over $30 billion in the quarter against the $10.8 billion they shipped. His phrase was that demand for XPUs and networking is simply insatiable, which, CEOs love adjectives, but the booking number gives the adjective teeth.
That's the human piece I keep coming back to. These aren't people lining up for a phone launch. These are AI labs and cloud giants basically reserving their place in a supply chain years ahead. Because if they're late, the model cycle moves on without them.
Right, and that is why inventory jumped. Inventory rose 46% sequentially, days of inventory went from 68 to 86, and management tied it to preparing for accelerating AI growth. So the big question is not, is demand there? It's, can they convert this without giving up too much margin or taking weird balance sheet risk?
And there is also that little chips-only clarification, right? After all the rack and financing noise?
Yes, and we should come back to that. Management was very clear on the call, no rack, it's all chips. But they also talked about this Apollo and Blackstone platform around AI compute deployment, so not a contradiction necessarily, but definitely a place where investors are going to keep poking.
So first impression, excellent quarter, huge AI visibility, stock hates the future complexity.
That's the clean version. The less clean version is Broadcom is becoming a central nervous system for AI infrastructure, and the market is trying to decide whether that deserves a premium or a migraine.
Beautiful. All right, let's get into the details, because I think the inventory line might be where this quarter really starts talking.
Yeah, inventory is the tell, but not because inventory is automatically bad. In semis, inventory can be confidence, or it can be future regret with a barcode. Broadcom is saying this is confidence.
That is such a bleak little barcode image. But okay, confidence because they're pre-building for the AI ramp?
Exactly. CFO tied the higher days of inventory to accelerating AI semiconductor growth. And that matters because these are not random parts sitting in a warehouse. If you're doing custom XPUs and AI networking, you're coordinating wafers, packaging, customers, power, deployment schedules. The whole physical world has to show up on time.
So it's less, oops, we overbought, and more, we are stocking the kitchen before a banquet we think is already booked.
Yes, but banquet risk still exists. If a customer's deployment slips, you cannot just return a custom accelerator to the chip store with a receipt. The bookings help, obviously. Over $30 billion of AI semiconductor bookings against $10.8 billion shipped is a serious signal. But bookings are not cash in the bank.
Right. They're promises with paperwork. Better than vibes, worse than money.
Nicely put. And the other thing is visibility. Haktan said, our visibility runs all the way to 2028 right now. That is honestly wild for semiconductors. Usually, chip cycles give you a flashlight. He is claiming floodlights. Actually, no, let me say that better. He's claiming the customers have already handed him the map.
Which is powerful, but also a little eerie, because when everyone can see 3 years out, I start wondering what everyone is choosing not to see.
That is the right discomfort. He also said they've secured supply for 2026 and 2027 and are working on 2028 and 2029. So the balance sheet and the call line up. Inventory up, supply commitments implied, customers booking ahead. This is a supply chain land grab, not just a revenue acceleration.
And weirdly, not a huge factory spending story for Broadcom itself.
That's the beautiful part of the model. They generated over $10 billion of free cash flow, while CapEx was only a few $100 million. They're not building the fabs. They design, they control key customer relationships, and they use manufacturing partners. So AI growth hits working capital more than it hits their own concrete and steel budget.
But that also means the partner dependency becomes enormous.
Yes, the prior filing said roughly 95% of contract manufactured wafers came from TSMC. We do not have a Q2 update on that, so we should be careful. But if you're doing AI ramp that depends on external foundry capacity, supply chain execution is not a footnote. It is the machine.
Okay, so that's the first big idea. This quarter is not just AI demand is strong. It's Broadcom is trying to choreograph the supply chain before the music speeds up.
Yes, and then the second piece is margin, because this is where investors got twitchy. Management guided Q3 gross margin down to about 74% from Q2 non-GAAP gross margin of 77.1%. The CFO said, this decline in gross margin does not represent a structural change in semiconductor margin.
Translation, please do not panic. This is mix.
Exactly. AI semis are becoming a larger share of the company, and those carry a different margin profile. But operating margin is still guided around 67%. So the message is gross margin comes down, operating leverage saves the day.
Yes, the margin line is lower. Please notice we are still absurdly profitable.
That is basically the Broadcom house style, and to be fair, they've earned some credibility there. Operating expenses barely moved while revenue jumped this quarter. That is real leverage. But investors are asking whether the company's becoming more hardware-weighted just as the AI hardware business gets more complex.
And then comes the phrase that keeps echoing, chips only.
Yes, in Q&A, they were very direct. No rack, it's all chips. And another line was, we're in the chip business only. I believe that as the intended business model. They do not want to be seen as a rack lessor or infrastructure financier.
But then there's Apollo and Blackstone.
Right. Management also described an AI XPU platform with Apollo, Blackstone, and other investors aiming to deploy more than 20 gigawatts of compute capacity through 2028, with a first tranche valued at $35 billion. That is not a tiny side quest.
So not we own the restaurant, more we supply the ovens and help the landlords finance the food hall.
That's good. And the question is where the risk sits. If outside capital funds the build-out and Broadcom simply sells chitch, great, clean model. But Q1 risk factors used broader language around AI racks or systems, leasing, financing, deferred payments, customer default type risks. Legal language can be broad, sure, but investors are going to want the filings to match the chips-only soundbite.
So we're not saying there's a contradiction. We're saying the call was narrow and the risk language was wide.
Precisely. And when the growth is this huge, small accounting and exposure questions become big market questions. Revenue recognition, credit risk, who is obligated to buy what when. Boring words, expensive consequences.
So inventory tells us they're preparing for the ramp, Margin tells us the mix is changing, and the financing language tells us the AI economy is getting more layered than a simple chip sale.
That's the quarter underneath the quarter. Broadcom may be extremely disciplined here. Hockton usually is. But discipline matters most when everyone around you is intoxicated by demand.
Which feels like the place to zoom out. The quarter was excellent, but the next question is whether excellence is enough when the market wants the future to be huge, clean, and somehow risk-free.
Yeah, and the strange part is the outlook is almost too strong to feel calming. Q3 revenue guide is $29.4 billion, AI semis at $16 billion, software close to $9 billion. That is not steady execution. That is a step change the market now has to underwrite.
Right, because if they hit it, the story gets bigger. If they miss even slightly, suddenly everyone asks whether the banquet was over-catered.
Exactly. And Hock Tan went further. He said, "We expect this momentum to continue into fiscal year 2027, and reiterated AI semiconductor revenue in excess of $100 billion. Look, that is a gigantic claim. Broadcom has credibility, but credibility is not immunity.
So next quarter is less about, is AI demand real, and more, can this company keep turning demand into clean economics?
Yes. Watch three things. First, does inventory convert into shipments and cash without weird receivable build? Second, does gross margin fall in the controlled way they guided, not in a whoops way? Third, do the filings get clearer on concentration and financing exposure?
And sentiment-wise, I think investors are basically saying, we believe you're important, we just don't know how complicated we're allowed to let you become.
That's well put. Broadcom wants to be the disciplined toll collector of AI infrastructure. The risk is that toll roads connected to frontier AI labs come with politics, financing partners, supply bottlenecks, and customers with enormous bargaining power.
Still, credit where due. This is not a vibes-only AI story. They have orders, cash flow, operating leverage, and a CEO who appears allergic to underconfidence.
Medically allergic.
So the verdict is impressive, expensive, and getting harder to analyze in direct proportion to how important it becomes.
That's the one. Great business, bigger questions. Next quarter, the receipts matter more than the adjectives.
Perfect place to leave the financial bit. Thanks for listening, everyone. We'll wrap it there.
If you'd like these earnings drops to just show up when the next company reports, following the show is probably the easiest little habit. And, tiny transparency note, this episode was made with AI assistance, with the company filings and earnings call transcript used as source material, rather than us winging it from headlines. If you've got feedback or a ticker you want us to tackle, send it to earningsunscripted@datamadness.ca. Thanks for spending time with us, and good night.